Okay, so I'm Shannon Osborne. I'm the Assistant Director for Financial Wellbeing in the Student Support Advocacy Center. This is one of what we call our Money Talk series, and this one's on creating a budget and managing credit. My co-presenter is Emily Melinda. She's the Graduate Assistant for Financial Wellbeing. She's going to help me with the recording and all that kind of stuff as well, and just kind of making sure I'm on track. But she's going to kind of just be there to support, we'll say. But yeah, so this one is on, like I said, creating a budget, managing credit. It's really important, especially for graduate students, to be able to set a budget for themselves, stick to a budget, understand everything when it comes to financial well-being. So let's go ahead and jump right on into it. And feel free, if you have questions along the way, to type in the chat or just let me know. Like I said, I will have time for questions at the end too, but just let me know. So whenever I do financial well-being sessions, presentations, I like to start with important terms to know. Think of it as like a financial glossary. It's like a vocab list of different financial words. So the first one is financial well-being. If you went to Google and you typed in the definition of what is financial well-being, you're going to see a bunch of different definitions. And here in the Student Support and Advocacy Center, we kind of created one definition ourselves. So financial well-being is creating a financial balance, a sense of security in your own life. It's a feeling of having the financial freedom to plan for today, tomorrow, and the future. The idea behind that is to say that financial well-being is really defined by yourself. My financial well-being might be, I want to have $1,000 in my savings account and I then feel financially secure, and that's my well-being. Another person might say, I want to be able to eat 3 meals a day and be able to put food on the table for my kids, and that might be their financial well-being. The point is that everybody's definition of financially secure is going to be different, and that's okay. It really just kind of depends. It could change over time. Your definition of financially secure might be different as a single person that's a graduate student versus a graduate student that has a family. The other definition is budget. So a budget is also known as a spending plan that outlines the money you expect to earn or receive, your income, and your expected expenses. It helps you track your spending and saving activity for a given period of time. So it's the idea of, if you stick to the budget, you'll be able to save that you need to in the future. It's okay some months we'll talk about to go over a budget, but so you want to make sure you go under the budget in the previous month to make up for it. But either way, the budgeting is definitely setting it up to make sure that you're sticking within your means of your finances. Credit, it's the ability to borrow money or access goods or services with the understanding that you'll pay later. Caution, usually subject to interest and or additional costs or an annual fee, like a credit card might have an annual fee. Direct costs. These are expenses that are directly related to your education. So think about it as expenses that are billed by student accounts here at Mason. So tuition and fees, for example, are billed by student accounts. Those are direct costs. Room and board, if you live on campus, those can be considered direct costs. If you live off campus, though, room and board will become indirect costs. So expenses that are indirectly related to your education and our expenses have in general for being a student. Books, room and board, personal transportation. These are expenses you just have for being a student, even though Mason doesn't bill you for them. Okay, so a couple other definitions. Loan is the money that needs to be repaid to the borrower, usually has interest. And the borrower is the person that's borrowing the money, typically a loan that then has to be repaid. A cosigner is an individual who signs a loan or credit account for another person as a support credit of the primary signer. So if you can't get a loan on your own, some loans may say you can get a cosigner that could be a secure person to sign on the loan on your behalf as well. They are then responsible for the loan too. A lender is an organization or person who lends money to a borrower. And a servicer is a middle organization that collects loan payments from a borrower on behalf of the lender. So these are really important. We're going to talk about, think about it in the minds of student loans. So if you have a direct unsubsidized loan for being a graduate student, the loan is the unsubsidized loan. You are the borrower, the student. They don't require any co-signers on the unsubsidized loan. The lender is the U.S. Department of Education, or the government in this case. And the servicer is the middle person you're going to work to once you graduate to begin repayments with. So this could be like Mohila is a common servicer, those kind of things as well. So you don't repay back to the school, you repay back to the servicer on behalf of the lender. Interest rate, it's a recurring fee, usually monthly, charged by the lender that's added to the principal of the loan or credit balance. And there's different types of interest rates. There's a fixed interest rate, which means it never changes for the life of the loan. And then there's a variable interest rate, which means it could increase or decrease depending upon the economy and the different sets by the interest rate by the government as well. So fixed interest rates never change, variable could change. So just kind of keep these definitions in the back of your mind as we go through this presentation. So let's jump right into the budgeting first. Really, there's a lot of different reasons of why you want to budget. I like this graphic here because it talks about 19 reasons that you even want to stick to the budget. And let's just talk about some common ones. Obviously, you'll spend less money. So if you stick with your budget, then you'll be able to make it last longer, which means you'll eventually spend less money because you're more aware about things. You'll argue less about discretionary spending. I like that one too. That's definitely huge because you can butt heads with a spouse or anything like that if you're overspending, or if a roommate or different stuff like that. Finances can definitely cause conflict, so it helps stick within that. And then as well, you'll feel more control of your finances. I really like that too. Definitely wanting to be able to control how you spend your money, seeing where the money goes is another good reason to budget. This then coincides with wanting to be more responsible and never missing any bill payments, which then helps alleviate some of the stress. So like I said, a lot of these kind of overlap with each other, but really we kind of talked about in the SSAC office why we budget. And so the first is it's easier to manage your money and reach your goals, as we talked about, being able to manage it every month and then setting certain goals, financial goals for yourself that you can start budgeting and saving for. It's a skill that'll help you manage your money, not only in the present, but in the future. If you can learn how to budget now, when maybe your family isn't as big, maybe you're on your own, it just kind of depends. It's really going to help you in the future when your family definitely expands. Recently, I had twin baby girls that are now 4.5 months old. They're newborns. And we went from a family of 3 to a family of 5. So that's going to really drastically adjust what my budgeting should look like every month. So skills I've learned earlier in life will then take me into where my family's growing at this point. Most importantly, it avoids unnecessary debt. A lot of times if people overspend what their budget is for the month, they may have to put it on credit cards or different debts like that as well to help make it through until you can get to the next paycheck. Sticking to the budget means you're not using unnecessary debts. So what are the different types of expenses? An expense is the money that you, or is the anything that you spend money on. We broke the expenses down into 3 main categories. The first one is fixed expense. Fixed means it never changes. You know exactly what that monthly payment is going to be, no matter when it is. The biggest one would be like rent or mortgage. So every month, you know, because you signed a lease, it could be a year lease or a 2-year lease or a 6-month lease. Either way, you signed a lease or a mortgage statement that says you're going to be paying $1,500 a month towards rent. So you know exactly what that's going to be every month. Cell phone bill. Sometimes that can change. It just depends if you add a line or it depends on what your plan is. But for the most part, the cell phone bill never changes for the life of it, for the entire term of the cell phone bill. Same with car payment, subscriptions, medications. Those could potentially change depending upon the situation, but for the most part, those are pretty fixed and never change. Next is variable expenses. So these are expenses that could change depending upon the month. So the first one would be groceries. I think we're all definitely feeling this with inflation, but groceries could be more expensive one month and less expensive the other, depending upon what you need to get. Utilities, definitely this can then fluctuate depending upon the time of the year. So your electric bill might be really high in the summertime because you're using your air conditioning, which is electric for you. And that's really increasing the monthly payments in the summer. Then in the winter, it might be really low because now you're using gas to heat your home. And so that's going to be a lot lower, but then your gas bill is going to be higher as well. So either way, your utilities can definitely change month to month. Same with credit card payments, depending upon how much of it you use and the interest that accrued, it could change month to month. The next is what we call periodic expenses. So these expenses that you have that aren't every month necessarily, but you have them throughout the year. So the best example of that would definitely be tuition and fees. So tuition and fees, you know for sure you have that in the fall semester, the spring semester, and maybe if you take summer classes, you might have in the summer as well. Gifts. So the month of December might mean that you're spending a lot more money because you might have Christmas or Hanukkah or any sort of holiday that you have to buy presents for, or birthday presents for people throughout the year. Same with traveling, and then taxes too, especially if you live in Fairfax County and you just recently had to pay the Fairfax County car tax. that's something that you only had to pay in October. It's not something you have to pay every month. So these are things you want to think about when you're creating your budget. What are my fixed expenses? What are my variable expenses? And what are my periodic expenses that I have? Okay, and then when you go to finally set your budget, you want to decide how you're going to set up your pie chart of a budget, as I would call it. Here in the SSAC office and the financial being team, we created what we call the 50-20-20-10 rule. And really keep in mind, this can change depending upon your situation at the time. But either way you cut it, you want to make sure that at least 50% of your monthly expenses go towards what we would call the needs category. So this could be like your rent, your mortgage, utilities, your groceries, your car payment. This is what you physically need to make sure that you're paying. Think about it as keeping a roof over your head and food on the table kind of idea. Those are what we call the needs for sure. So at least whatever your budget is division wise, we want to make sure that at least 50% of it is going towards the needs. Next is the want. So in this one, we did 20%. So that could be like dining out, entertainment, shopping, traveling. Those could be the wants that you have. And then we said 20% going towards your debts. That's a little bit high, especially if you're a student right now, because you shouldn't really worry about using money to pay off the debts right now. That's something you want to do once you graduate and get that full-time job. And then 10% going towards your savings. So that could be putting it towards investing into a 401k or an IRA, or maybe to your future child's education. Either way, it's a savings amount. Now, when I say this 50-20-20-10 rule can definitely change, it can be adjusted. So you can say, I'm a student right now, so I don't really have any savings that I want to focus on. I don't really have any debts that I want to pay off. So I want to put 70% of my income into the needs. And then I want to put 20% into the want and 10% into the savings. You can for sure change this pie chart however you need to at that time. And then once you graduate and get a full-time job, you might put less into your needs and more towards your savings area. But the point is that it can definitely change no matter what your situation is. Okay. So next is, people always say to me, how do I then get started? How do I use a budget sheet, and what budget sheet should I use? My answer is very simple. Use what works best for you. So the reason I say that is because, I could send all of you guys a budget sheet right now and say, go ahead and fill it out. Let's work on doing a budget sheet together. You're then going to lose it. You'll delete the email, you'll print it out, but then crush the paper at the bottom of the backpack and you won't use it again. Statistics say that you're more likely to use a budget sheet if you've created it yourself. If you've invested time into creating a budget sheet or creating a budget platform that works best for you, you're going to then be able to stick to it and use it every month. If I just hand you something, you haven't invested anything in it to feel like you want to do one. However, I'll talk about different budget sheets that you should look at to get yours started. The first one is just printing out a budget sheet. You could go to Google right now and type in budget sheet and see a whole bunch of different ones under image that you can print out. Budget sheets would often look like this. So on this budget sheet we have, for example, here on the left, you're going to have your monthly budget on the left of the columns and then what you actually spent on the right. So at the beginning of the month of, let's say, November, you'd sit down and map out exactly what your budget is for your fixed expenses, for your variable, for your periodic expenses as well. And then throughout the month, as you spend the money, you'll enter in the dollar amount that you spent. And so at the end of the month, you can see how much over your budget you went, how much under your budget you went, or if you stuck to your budget completely. But you'd be tracking it throughout the month. There's other resources you can use for budget sheets as well. Any other ones online can work as well. You'll definitely want to look at the templates for Excel. So if you open up an Excel spreadsheet, you can go to different templates and one of them can be a budget template as well. Then you want to create your own that fits into what your needs are. I talked about that a little bit before. If you're one like me that likes to use apps on your phone, I really recommend looking at mint.com. Mint.com can then link to your bank account to see exactly what you're spending your money on. So it can say this month you spent X amount of dollars towards eating out, or this percentage went towards your monthly fixed expenses, so your rent and your housing and those kind of things. Nerdwallet.com works as well, and you can also talk to your local bank. So your bank may as well have different options that you can use to check your budget, and you can meet with them too. If you want to sit down one-on-one with our financial well-being team, I'll put there's a contact at the end of this presentation, but we can sit down with you and kind of map out your budget. The biggest things you're going to want to know is identify where your income is coming from. So, are you paid monthly because you have a stipend from the university? Do your parents contribute anything or not? Those kind of things as well. So you want to first identify where your money's coming from, and then identify what your expenses are, and then we can kind of work to divide up where the expenses are with everything. But I definitely recommend looking into those different options as well to get you started. So next we're going to talk about things to consider when you go to create your actual budget. So some things that we want to talk about is first spending costs put into different perspectives for people. So it's not really until you start spending money that you realize how much you're spending money on. So we like to give the example of a shirt. So you might be out shopping and you see a shirt that you want for $25 and you say, you know what, this is only $25. That's not a big deal. I'm going to get this shirt. And then you go later that month to the store and the same thing happens again. You want to get a new shirt and now that's $50 you spend. And if you times that by the number of months in a year, you would have spent $600 on buying new shirts. So it's really the idea that right now in this moment, $25 might not seem a lot, but it can definitely add up over time. Next is the Chipotle example that we have here. That's maybe a little bit more relatable example. So you might be running late for class and say, you know what, I'll just buy some Chipotle at the JC for lunch today because I'm running late. And that costs $8.35. Well, if you do that twice a week because you're running late twice a week, you're looking at a little over $16 that you would have spent at that week. Times the number of weeks in a year, you're looking at roughly $832 for the year went towards just eating out at Chipotle, and you have nothing in return for it except for the fact that you had lunch at Chipotle. And could you have saved money by eating at home, bringing a packed lunch, making your lunch the night before? And then you can see the example of an Uber Lyft ride versus like taking a bicycle or different stuff like that. Next, we're going to talk about needs versus wants. So this is kind of a little bit more of an interactive part of the presentation. So feel free just to kind of utilize your chat there. But I want to talk about what are needs versus wants. So for example, a cell phone. Would you guys say that a cell phone is a need or a want category item? And like I said, feel free just to type in the chat there what you think it is, a need or a want cell phone bill or having a cell phone. A need. Yeah, you definitely could say it's a need because now in society, you can hardly get by without having a cell phone. You need to have it for security reasons. You need to have it to get in touch with professors. Either way, it definitely could be a need. Now, think about it this way. Would you say having the latest Apple iPhone 14 is a need or a want in this case? True, it's a want. So having the latest and greatest phone might be more of a want than a need. Could you be okay with having an iPhone 13 instead of a 14 and still get the same kind of service you have on your cell phone that you could have with the 13 versus the 14? The idea is that the need might be physically having a phone. However, the want is the different type of phone. A more expensive phone might be more of the want category versus the need category. What about Netflix? Would you guys say Netflix is a need or a want? Someone said want, yeah. Yeah, you could say the point is with Netflix, I would argue that it's a need for me. The reason I say it's a need is because at the end of the day, especially because I have kids in school and everything like that as well, I want a way just to have some me time at the end of the day before I go to bed and unwind. And so I want to watch like a Netflix show just to have some self-care and unwind a little bit. I don't want to pay for cable, so instead I want to pay for Netflix. That might be more of a need category for me because my mental health is important as well in this situation. Or somebody else may say, you know what, reading a good book is really all I need for mental health. So I don't want to spend money on Netflix. So that becomes a want for me instead of a need. Going along with that too, what do you guys think about gym membership? Do you think a gym membership is a need or a want? Yeah, both of you guys said need for me. Yeah, exactly. So it's similar to the Netflix. You can just decide, for my mental health, I really need to have a gym membership because it's really important for me to focus on my health, which then makes me feel really good, which makes me focus more in school, which then makes me eat better and overall feel better. So that may become more of a need for you, or somebody else may say, all I need to do is go outside and go for a walk outside and I can have exercise that way. So gym membership is more of a want for me. The idea with this needs and wants exercise was really just to get you thinking about the needs and wants. It's not very black and white, right? Like a cell phone bill, you could argue a need or a want. A gym membership, you could argue a need or a want. And your needs and your wants are not going to necessarily be the same as your classmates' needs and wants because it really just depends on how they do their budget and what they want to prioritize as their true needs versus wants. When you're thinking about ways to save money, the obvious ones we talk about are bus, carpool, walking, taking a bike. Carpooling is the most important one too. If you need get a ride from a classmate to save money versus taking an Uber ride home. Attending free events on campus. You can go to Mason 360 and look up all the different events. Some of them even have food. So on the days that you forgot your lunch or didn't have time to make your lunch at home, instead of going to Chipotle and spending the $8.35, maybe go to Mason 360 and see if there's any events today on campus that might have lunch included. So you can get free lunch if you go to said event. Volunteering at events. So I talk about a former coworker from a previous institution that I worked at. And every Monday morning she would come in and her name was Judy, and she'd say, good morning, Shannon. How was your weekend? I'd say, oh, same old, same old. How was your weekend? And she would say, I went to this concert, I went to that concert, I did this event, all sorts of things. And I would say, how do you have the time and money to do all of that? And she would tell me that she volunteers at different events. So maybe it's a concert, we'll just throw out Billy Joel concert or something. She'd be volunteering to help people find their seats, to collect tickets or coat check or different stuff like that. And because she's volunteering for the event, she can then stay and enjoy the concert as well because she is part of the volunteers too. So she didn't have to spend any money on the concert whatsoever, got to have some entertainment as well. And it was just a really creative way for her to be able to save money, but also attend hundreds of concerts for free. The make your own coffee at home. I know this is such a silly example that we've heard time and time again, but it's so true. If you think about all the money you spend at Starbucks or different stuff like that on campus, Dunkin' on campus as well, then if you would have made coffee at home and put it into your mug, could you have saved money that way? The same with a lot of offices. A lot of offices want to encourage students to come in and meet with them and talk to them. So a lot of departments around campus might have a little coffee and tea area at the front of their office. So if you are running late to campus one day and you forgot your lunch and you don't have your coffee, you could go into different departments, see if you can get some free coffee if you just kind of talk to them for a little bit, and then go to Mason 360 and see if there's any events on campus that you can get some lunch for. And right there, you probably saved about $15 just from doing those. And if you did it every day, then that really can add up in the savings category. Using your student discount, so your George Mason University ID card that you have. A lot of places you might go to at a museum that might say that they have a student discount, and that's really awesome. You can definitely tell them and show them, but a lot of places don't advertise that they have student discounts. So you might just want to ask them, hey, I was just curious, do you have a student discount? I saw you have a military one. Do you have a student discount as well? The worst they're going to say is no, but it's definitely worth just asking, even if they don't advertise it. So like I said, the biggest thing I want to recap is identify where exactly your money's coming from. Track where you're spending your money, create the budget that works best for you, whether that's online, whether that's a dry erase board you're manually writing out yourself, whether you're printing something else out and sticking to it. Record your needs and wants and really live within what your income is. And in the chat here, somebody posted that Hulu is just $1.99 with your Mason email. So there's a lot of different areas like that that offer really cheap services if you just use your student information. Like I said, you just don't know unless you ask for sure. And using that student email address helps as well. I believe, I don't know if it still is, but I know iTunes used to have a subscription one that was cheaper for being a student as well. And even Amazon, for example, has a cheaper membership fee to Amazon for purchasing books and everything if you're a student too. So really just kind of investigating those student discounts as well. Okay, so as we transition now, we're going to go from budgeting to talking a little bit about credit and credit score. Okay, hold on. Okay, so first is, what is credit? Credit is the ability to borrow money or access goods or services with the understanding that you pay it later. Important terms to know when it comes to credit is principal. Principal is the amount that you borrow, and interest is the amount that's charged, usually monthly, that's expressed as a percentage of the principal or credit balance of the use of these assets. So the biggest thing I say is, in our country, you have to have credit to get credit. So there's a difference between good credit and bad credit, but you definitely have to have a credit history in order to have good usage in the future or get a lower interest rate. So what are the different advantages and disadvantages of credit? The first is you can buy now and pay later. So the idea is that you're using your credit card to buy the shirt that you want right now, but you don't have to pay it off till later. So you don't necessarily have the funds, but you need to have this shirt because you have a job interview, so you can buy it right now and you can pay it off later. Next, you can make purchases online. So this could be a really secure way to make online purchases so that you don't get your identification and your money stolen. You don't have to carry large amounts of cash. Cash in your wallet, if your wallet's stolen, is definitely, if you carry around $500 cash in your wallet, that gets stolen, immediately you lost $500 right there with no way to make it up. You can establish good credit history. So like I said, in order to get good credit in the future, you have to have credit in our country. And it can be safer than a debit card. And that safety comes from the fact that if you use an online purchase and they make a mistake or they steal your identity, you can easily call your credit card company. Sorry, sorry. Let me just unplug the Alexa here. You can easily use your credit card so that you can pay off things that way, and call your credit card company and say, hey, my card was stolen and I didn't make this purchase for $400 at Walmart, so I need to cancel my credit card, and they can do that. Where if it's your debit card, that's an actual card that hooks up to your actual money in your bank account. So if that $400 is gone, then it's just gone completely. What are the disadvantages to credit? So you end up spending more than you would have used with cash. So it's a lot easier, right? Just to swipe here, swipe there, use a card, because you're not physically seeing it disappear from your wallet. If you're using cash, you can physically see your cash getting lower, and so it's not as easy necessarily to spend cash. Items purchased may cost more if you don't pay it off for the balance each month. So that idea comes from the credits can then over go into the next month. So the idea is that if you're swiping and swiping and swiping and you're just paying them in monthly payment, then that credit can roll into the next month. And then the debt really hinders you from saving. So if you have a lot of debt you need to pay off, you can't save as much. You can also establish poor credit history. So if you don't make on-time payments, then your credit score can go down because you're not making those on-time payments. So there's different things you probably heard of too, like a FICO credit score, a credit reporting agency, a lender, different things like that. So who reports to whom? So when you go to borrow a loan, that's going to be from the lender. Let's say you go to purchase a vehicle, and then you're going to get it from a lender that's going to be Chase Bank, we'll just say. So Chase Bank would be the lender who's lending you the money so you can purchase a vehicle. They're going to then get information from the credit reporting agencies on what your FICO credit score is to determine what the interest rate can be on the loan for the vehicle. So all of them just kind of circle around each other. Those credit reporting agencies are reporting out the FICO score, and then FICO score is giving it to what the lender is, and the lender is kind of reaching out to the credit reporting agency to find out more on that score. So what makes up your FICO credit score? So roughly about 35% of your credit score comes from on-time payments. So on-time payments is the number one thing you definitely want to make sure you're doing when it comes to repaying any of your debts, so that you make sure that that FICO credit score is the best that it can be. 30% then comes from capacity used. So capacity used means of all the debts you have right now, so credit cards combined with student loans, everything like that, you have about $20,000 of debt that's available to you. Of that, 15,000 is currently being used. So 5,000 you have available to use at any moment that you need to. So a car lender is going to look at that to say, okay, well, they have $5,000 available credit right now. So they can put 5,000 down for the car. That's going to give them about this X amount of interest rate and monthly payments on that amount. If you use all of your capacity that you have, then it's going to be even a lower credit score. This is when you hear people talk about the 60% rule. You typically don't want to be using more than 60% of the credit that you have available to you. So really that's where the idea comes from, is you want to have some available credit on your account. So those two alone, on-time payments and capacity used, make up more than 50% of your FICO credit score. The next is length of history. So this is really how long you've had a credit history. So for example, if you've just opened up your first credit card and you're just 21 years old, you're going to have a really low credit history, a really short credit history, versus somebody who might be 45 years old who opened up their first credit card 20 years ago is going to have a really longer credit history. The length of the credit history just makes it so you appear trustworthy. Credit scores come from those that can appear trustworthy in that sense. So the idea is that you have established good credit history, you've made your on-time payments, so lenders then want to lend to you because most likely they'll get their money back. 10% is from new credit. So you want to make sure that you're not just going out there and applying for 10 different credit card company bills, and then all of a sudden you have all these new inquiries that are coming through. Those can definitely weigh heavily on your credit score. And then the types of credit usually make up about 10%, and those kind of vary on the different types of credits that are out there. Okay, so now we're going to do an interactive part that's kind of a knowledge check. So I'm going to do a little pop quiz to kind of ask you guys some questions. So just go ahead and put in the chat what you think the answers are here. So placing utilities in your name is a good way to build credit. True or false? Do you think that if you put utilities, for example, the electric bill in your name and you pay monthly on the electric bill, that you're going to be establishing good credit or bad credit by doing that? Do you think that's going to be a good way to build the credit? Yes, true or false? Or yes or no, either way. So the answer is false. Most utility companies actually do not report your payment information to any credit reporting agencies at all. The only ways that they report the information is if you miss a payment. So you don't get any credit for making on-time payments for utilities or your electric bill. You can only lose credit if you miss your payment or you go delinquent or they have to turn your electricity off, those kind of things as well. So just keep that in mind. Utilities can only hurt your credit. They can't improve your credit. And the idea is because utilities is a need, it's not a loan. It's not something that you're lending type thing. But the on-time payments will be the key there. All right, so let me move the chat here so I can see. So people spend more money when they use credit. True or false? True. Just like I said earlier, research indicates that credit users make larger purchases with credit than they would with cash, right? It's really easy to swipe by card, so that $5,000 purchase for a vehicle seems really doable, where if you had $5,000 of cash in your wallet, that's a big deal to spend that kind of money. Using your debit card wisely will help you establish good credit. So true or false? Using your debit card wisely will help you establish good credit. So correct, it's false. So the reason that is because a debit card is not a credit card. Debit card withdraws money directly from your checking or savings account. Even though it may have a MasterCard or a Visa logo on that debit card, every time you use your debit card, you're just pulling out your actual money from your account. It's not until you use your credit card that you're going to eventually be establishing credit, but using a debit card doesn't do anything to your credit score at all. All credit cards are created equal. So think about it. So all credit cards are the same. Basically, Discover card is the same thing as a MasterCard. Exactly. We recommend reading the fine print. Some credit cards might have a lot higher interest rates. Some of them might have an even higher late fee. You definitely want to make sure because they're not all going to be the same or used the same way. A credit card comes with a credit limit. True or false? So true. So those credit cards that you apply for are going to say maybe we have a $500 limit on what you can use. So you just can't use anything more than $500 total on this credit card. They're determined largely by your FICO score. A better FICO score is going to have a larger limit that you have. A lower credit FICO score is going to have a lower limit. Missing one payment will not impact your credit score. True or false? So false. Even one payment would be indicated on your credit report that it can possibly hurt your credit or show that you can't pay on time with something. So you want to make sure that you're definitely paying on time every month. If you cannot make a payment that month because finances are difficult, let's say it's the month of December and it's the end of the fall semester, so your refund from student loans is not really there anymore. You're kind of waiting for the January refund from spring to come in place. Let's say that you just can't possibly make this monthly payment on your credit card. You can call the credit card company proactively before your payment is due and just say, I really can't make this $100 minimum monthly payment. And they can sometimes, if you've never asked before, give you about 14 more days until your paycheck comes in to help with it. And it won't hurt your credit score. It won't show that you're late on anything. So a lot of people don't know that they can proactively call their credit card company and ask for a little bit more time on the monthly payment that month. And I say the month of December because sometimes that can always be a tough month with all the holidays and then it also being the end of the fall term if you just can't make that minimum monthly payment. Your car insurance rate is tied to your FICO score. True or false? So the monthly payment you make towards your car insurance premium is determined by your FICO credit score. True or false? So this is actually true. So when you go to apply for car insurance and you contact the car insurance company, they ask for your social security number, they will pull your credit. How much you pay in your premium is tied to your credit score. So those that have a higher credit score, car insurance companies think that that indicates good driving because you're a trustworthy person. So you're going to have a lower premium that you have to pay if you have good credit score. If you have a low credit score, you're going to have a higher premium. Whether you agree or disagree, that's just how they view it. So for sure, depending upon your credit score is, if you get a better credit score, you could possibly get a lower premium on your car insurance. Oops, sorry. So what are the next steps? So we definitely have learned a lot about credit scores and what goes into a credit score. And really, what are the next steps after this? So first is you want to review your credit load, see how much you have, what you can pay off and chip away, how this will adjust what your credit score is. Set realistic goals for yourself when it comes to paying off the credit card. So you might want to be putting more of your budget into paying off some of the credit cards to lower it. We also signed everybody up at the university for what's called Cash Course. So Cash Course is an online financial literacy program that can talk more about credit scores and budgeting too. So we recommend that you check out the Cash Course information on our website and that you work on trying to establish a savings account right now. Even though if you only pay $1 or $2 into it, at least you can start trying to save for the future. And then considering paying with cash or going without, maybe you're using it just to say, okay, this cash is the cash I'm going to use this month to eating out. Once that's gone, I can't eat out anymore. I have to make sure I'm cooking at home because I want to save money that way too. You can also request a free copy of your credit report from each credit reporting agency every year. So you can ask for your credit report score, go ahead and see it and kind of see what you need to adjust there. These are the 3 credit reporting agencies that you can ask it from: Experian, Equifax, TransUnion. A lot of the credit agencies report different stuff differently, so your credit score might change depending upon which credit reporting agency it is. Um, uh, Also the same thing too, when you go to apply for a job, you might just want to pull the credit report, just kind of see what everything looks like as well. Okay, so there on our is our website, our financial well-being website. Here's our email address as well too. You can definitely email us if you want to ever set up a time to meet to ask about anything when it comes to credit or budget or anything like that. But I'm going to go ahead and to have Emily hit the stop recording button.